Welcome to Talk Tickers, where we're diving into the latest earnings call for Constellation Brands. That's ticker STZ. They just dropped their Q3 fiscal 26 results, and believe me, there is a lot to unpack here.
So, right out of the gate, check this out. The market apparently loved what it saw on the January 8th release. The stock jumped more than 5%, and get this, on more than double its usual trading volume. Now, that kind of move tells you Wall Street was definitely paying attention.
But here's the twist, and this is where it gets really interesting. Why the big rally? Because it happened at the exact same time the company cut its profit forecast for the whole year. You heard that right. A solid beat, but a guidance cut. So, what gives? That's the puzzle we're going to solve. Let's dig in.
All right, so let's start with this whole beat and a cut situation. It's really the core tension in the entire report.
Okay, let's break it down. On one side, you've got the good news, the beat. For Q3, they absolutely crushed it. Earnings per share, $3.06, when the street was only looking for about $2.78. That's a solid 10% beat. Revenue was also better than expected. But then, you look over at the right side, at the cut. Management lowered their guidance for the full year. And that new range, it's now below what analysts were hoping for. See the conflict?
So you've got to ask, right? Why on earth would you lower your forecast after such a great quarter? Well, it all comes down to a major headwind they're seeing with their customers.
And management didn't beat around the bush on the earnings call. They were super clear. The problem is some weakness in demand from their key Hispanic consumer base. I mean, they said about 3/4 of these consumers are really worried about the economy and are, being a lot more careful with their money right now.
And you can see exactly how that consumer pressure shows up in the actual sales numbers. The beer business, their bread and butter, actually held up pretty well, only down about 1%. But wow, look at wine and spirits. That segment took a massive hit, down 14% compared to last year. That's a huge difference.
Okay, so if sales volumes are taking a hit, how in the world did they still beat their profit numbers for the quarter? Well, that's where management's playbook comes in. They have a very specific strategy for dealing with this exact kind of environment.
Their whole philosophy is about controlling the controllables. It's a great phrase. Basically, they're focusing on what they can change. So they're cutting costs wherever possible, they're being really smart about raising prices, and they're getting creative with their products. For example, they're introducing smaller 7-ounce packages, which is a smart way to give people a cheaper option without just slashing prices across the board.
But it's not all defense, they're playing offense too. They pointed to some really clear areas for growth. First up, Modelo. Believe it or not, it's in 20% fewer stores than its competitors. That is a huge runway for growth right there. Then there's Pacifico, which is on fire, especially with younger drinkers, and they're making big moves in bars and restaurants. Modelo is now the #2 beer on draft in the country. That is a really big deal.
Okay, so let's put all the pieces together. What's our take on the stock from here? This is what we call the next call, our rating, and what to look for.
If you're watching this stock, there are 3 main things to keep on your radar. In the short term, you want to watch the beer depletion trends. That's just how fast beer is selling from distributors to stores. Is it getting better or worse? Then, looking out to mid-year, you've got the World Cup. That could be a huge sales driver. And then the big one, the long-term story. Are we seeing signs that their core consumer is feeling more confident and starting to spend again?
So really, it boils down to 2 competing stories. The bull case is this: the worst is over. That guidance cut reset expectations, the market has priced it in, and now their awesome cost control will protect profits. The bear case? Not so fast. The consumer is still really weak, and that pressure could get even worse, eventually wiping out all the good work they're doing on costs and forcing them to cut guidance again.
So where do we land? We're calling this one a market perform. On one hand, you have to be impressed with how well the company is executing. But on the other hand, the consumer uncertainty is a huge, unpredictable variable. Right now, it feels like those 2 forces are pretty evenly balanced.
Which leads us to what we call the plausible trade. Look, the stock got hammered in 2025 before this little pop. It kind of feels stuck in the mud, with the bulls and the bears in a total tug of war. So instead of betting on a direction, a neutral trade could make sense. Something like a short strangle or an iron condor in the options market. With these, you're not betting it goes up or down. You're betting it goes sideways. You get to collect some premium while the market just figures out which way to go.
And as always, just a reminder, this is not financial advice.